you know what options are, and you know how the market operates. But before you place a trade, you have to answer the question every new trader asks: how does money actually change hands? When you trade a normal share of stock, everyone is generally looking for the same thing: the price to go up. The options market is different. It is a zero-sum environment where every single contract requires two people taking opposing sides of the exact same trade. On one side, you have the buyer. They go long, paying a cash premium up front to open the position. Their goal is massive, fast price movement. They're betting that the underlying stock will surge or crash in their direction before the clock runs out. On the other side is the seller. They go short, collecting that cash premium on day one. Sellers act exactly like an insurance company. They're banking on the fact that the explosive, dramatic move the buyer expects will never materialize. Options trading is not a single game with a single objective. It is a deliberate choice. You decide whether to hunt for low-probability infinite payouts or to build a high-probability income machine. This line chart shows the payoff for an Apple long call. Buying a $185 strike call at a $3 premium costs $300. If Apple's price surges to $210, your profit is theoretically unlimited. But if the stock crashes to $165, the chart flatlines. Your loss never exceeds the $300 premium paid. This works in reverse, too. Buying a long put gives you the right to sell shares at a set price if the stock drops. Investors use this as portfolio insurance. If you own Tesla shares, buying a put caps your losses in a market crash without forcing a sale. Because a buyer needs the stock to move in the right direction by a specific amount within a specific time frame, the odds are mathematically stacked against them. This is why buyers only win about 30 to 40% of the time. They accept a lower win rate in exchange for a capped, predictable downside and the potential for a home run. To manage this, buyers calculate their break-even point. This is the price the stock must reach just to recover the initial premium. For a call, it's the strike price plus the premium paid. If the stock doesn't reach that number by expiration, the trade is a loss. Hitting that target is a race against theta, or time decay. Think of an option contract like a carton of milk sitting in a refrigerator, complete with a firm expiration date. Every single day that passes bleeds value from the contract. This decay happens automatically, regardless of what the underlying stock price does. Time is the ultimate enemy of the buyer. If the market stays completely still, time decay will quietly bleed a buyer's investment down to zero. Let's flip the perspective. While the buyer races the clock before the milk spoils, the seller is the grocery store who already collected the cash. This chart shows a covered call. By selling the right to buy shares you already own, you collect a fixed cash premium, represented by this block. If the stock stays relatively flat and fails to hit the strike, the contract expires worthless. You keep the shares and the premium. You can run a mirror strategy called a cash-secured put. This allows you to get paid a premium to wait for a discount on a stock. If the stock drops, you buy the shares. If it doesn't, you keep the cash. While a buyer needs one specific outcome to profit, a seller wins if the stock moves in their direction, stays completely still, or even moves slightly against them. By covering more outcomes, sellers leverage time and probability to win 60 to 70% of their trades, accepting capped profits for a massive statistical advantage. A major trap for beginners is assuming you have to hold a contract until expiration day. In reality, stepping into the open market and selling to close your position early is almost always superior to letting an option exercise. This curve illustrates time decay on a 45-day contract. Professional sellers typically open trades with 45 days to expiration, and they exit the moment they hit 50% of their maximum potential profit. Closing the trade early locks in gains and eliminates the risk of a late-stage market reversal. Surviving this market requires strict parameters. You never sell naked options without owning the underlying asset, because the risk of a spike is unlimited, and you aggressively restrict your position sizes, risking no more than 2 to 5% of your total account on any single trade. Ultimately, neither side is better. Buyers thrive in high volatility, trending markets, while sellers excel when the market moves sideways. The true edge lies in recognizing these conditions and choosing whether to pay for potential or get paid for probability. We know how money changes hands, and we know how buyers and sellers manage their risk. But that leaves one final mystery. When you look at an options chain, how do you determine if the premium you are about to pay is actually a fair price?